Hey friends, have you come across stocks of companies that you really like and feel like investing, yet you feel that the current share price is just a bit too high to be of a good value? But you don't want to have your money, your capital sitting at the side doing nothing while waiting for the share price to come down, right? If that's you, then you may want to adopt this options strategy of selling put options as part of your investing strategy. So personally, I have been selling some put options to boost my returns as well, because I think this option strategy complements value investing very well. Before we begin, do help me like this video so that it can reach more people and hopefully they can benefit from this information we are sharing today as well. Alright, let's jump right in. So in case you are new to options, these are financial instruments that give the buyer of the options the right to buy or sell the underlying asset at a stated price, what we call the strike price, within a specified period of time. So for call options, they are financial contracts that give the option buyer the right, but not the obligation to buy a stock at a specified price within a specific time frame. On the other hand, put options are financial contracts that give the option buyer the right, but again not the obligation to sell a stock at a specific price within a specific time frame. Well, there's many ways people use options for trading, hedge, or as a form of leverage for investing. So we are not going through all that today. What we want to talk about is how we can boost our returns by selling put options while we wait for the share price to come down to the level that we want to buy in. So let's use a case study of Discovery's stock as an example so that you can understand better. And over here, I'm using Tiger Broker here to show you the actual options trading screen. So on the left side is for the call options and the right columns are for the put options. You can change the time frame at the top to see the market pricing for options lasting from a week to a month, a few months, a year or more. So for our sell put strategy, usually I will look at around options for around a week to around a month, because more than that, your capital may be tied up for too long or there may be more risk due to uncertainties over a longer time frame. So for now, observe that the current share price is around $26.90 and focus on the right columns, the put options for a 31 days duration. Think about the buyer of the put options first. The buyer of the puts are probably bearish about the price of the stock, so they think that down the road the price will drop to below a certain level. Take those who want to buy the put option with a strike price of $25, meaning they think the price may drop below $25, say they expect the price to drop to $23 over the next 31 days. So if the share price really drops to $23, they can buy the share at the prevailing price of $23, exercise the put option and sell the share at $25 and make a profit on the difference, which is $2 for this case. Of course, to gain this right to sell at $25 within the next 31 days, they have to pay a premium to buy this put option contract. To buy this put option contract, they have to pay a premium of say 60 cents between the bid and ask price for each contract. So understand that usually for options, they are traded with a minimum one lot that is equivalent to 100 put options. So for this case, the buyer of the put option will have to pay a premium of 100 times 60 cents equals to $60. So this gives the buyer of the put option 100 contracts the right to sell an equivalent of 100 shares at $25 per share within the next 31 days. At $2 profit, assuming the share price really drops to $23, the buyer of the put options earns a total of $200 profit on his option trade. Okay, what we have gone through up to now are in the perspective and motivation behind the put options buyer. Now, this is the part where we come in as value investors. We will be the ones selling the put options and collect the $60 premium from this put options buyer. So why do we want to do that? Remember, our motivation is that we have done our research and we think that this is a good company to invest in, but you don't want to buy at the current price of $26.90, but you are okay to buy it at $25 a share. So in the meantime, you can sell the put option, earn and collect the $60 premium immediately. So if the share price does not drop below the strike price of $25, then the put option buyer will not exercise that option, the contract will expire and you get to keep the $60 premium. Of course, if the share price does drop below $25, the buyer exercises the option, you are obliged to buy the 100 shares at $25 a share, which you are okay with because you have already determined beforehand that a good entry price will be $25 and below anyway. So of course, the downside is that you are not able to buy the share below $25 a share, but you can always load up more by buying the stocks directly. Now, imagine if the share price keeps hovering at the current level of around $26 to $27 a share for a year, but you don't want to overpay. So previously, the cash you saved up would have been lying at the side, being idle while waiting for the opportunity to enter when the share price drops below $25. Now, with this option strategy, you can collect a $60 premium every month by selling put options and waiting for the share price to come down to your desired level. So $60 times 12 months equals $720 in a year. On a base of $2,500 that you need to get ready in case you need to buy the shares, $720 is equivalent to 28.8% on the returns of $2,500 that was not earning anything while you waited at the sideline previously. So that's a pretty good return. Of course, there's some trading fees you need to deduct off the returns, or perhaps you are not comfortable with a $25 strike price for this case, you prefer to buy in at $22.50 a share instead. In that case, the premium you will collect will be lower, say for this case around 20 cents per contract or $20 per lot. At $20 per lot, it will give you a nice return of around 10% on your capital. So prices of the options changes depending on a number of factors, including the volatility of the share price and the actual share price itself. So do read up more to find out more if you are keen. So here I just want to share with you the general idea why selling put options can be a good way to complement a value investing strategy. So in fact, Warren Buffett adopts this put options strategy as well. But of course, he has the scale and power to create and negotiate the terms of the options that are more favorable to him. For us, we will just make use of the standard terms and pricing of the options from the open market. Nonetheless, I see this option strategy as a good way to complement value investing and boost returns for retail investors potentially up to 10 to 30%. Anyway, hope that you have learned something today. Do subscribe to the channel for more tips and updates, and I will see you next time.